As a Canadian investor, buying a foreign property can be an attractive proposition, offering you the chance to diversify your real estate portfolio and enjoy the lifestyle benefits. However, owning property abroad also brings with it certain tax implications that Canadians need to be aware of when dealing with their annual tax filings. I will discuss the various tax implications that come with owning foreign property and provide strategies for minimizing the potential tax burden. First and foremost, Canadians who own foreign property need to report the income they earn from their investment on their tax returns. This includes rental income, interest, dividends, and capital gains. It's important to remember that even if you receive some form of tax relief in the foreign country where your property is located, you must still report your income to the Canada Revenue Agency, CRA. When it comes to deducting expenses, Canadian tax rules apply in #8211, meaning you can deduct reasonable expenses incurred for the purpose of earning income from your foreign property. Some typical deductions include mortgage interest, property taxes, insurance, maintenance and repairs, and property management fees. Foreign taxes paid on the income can potentially be claimed as a foreign tax credit, reducing your Canadian tax liability for the same income. Canadians who own specified foreign property with a total cost of over CAD $100,000 must file Form T1135, Foreign Income Verification Statement, with their annual tax return. Specified foreign property includes real estate, bank accounts, stocks, bonds, and other investments held outside of Canada. The purpose of this form is to provide information on the foreign investments to the CRA, helping them track and monitor Canadians' foreign assets. Failure to submit Form T1135 when required can result in significant penalties in #8211, up to $2,500 per year for each year the form is not filed. In more serious cases, additional penalties and even criminal charges may apply. Therefore, it is crucial to accurately report the requisite information and submit the form on time. When you sell a foreign property, you are required to report the capital gains to the CRA, and pay tax on 50% of those gains at your marginal tax rate. However, it's important to note that Canadians are not eligible for the principal residence exemption on foreign property. This means that if you decide to sell a vacation home or another foreign real estate investment, you will not be able to use the principal residence exemption to shield your capital gains from taxation. In order to minimize your tax liability, consider holding your foreign property for a longer period or investing in a Canadian real estate market, where you can still qualify for the principal residence exemption. Properly documenting the costs of any improvements made to a foreign property can help increase its adjusted cost base. This can ultimately help reduce the amount of capital gains subject to tax when you eventually sell. Canada has tax treaties in place with many countries to eliminate or reduce double taxation of income earned by Canadians from sources in those countries. These treaties can help prevent you from being taxed twice on the same income in #8211, once in the foreign country where your property is located, and again in Canada. To claim the benefits of a tax treaty, you generally need to prove that you are a resident of Canada for tax purposes, and that you meet the criteria set out in the treaty. It is crucial to understand the tax implications of owning foreign property and stay compliant with the CRA's requirements. Proper planning and consultation with a tax professional can help minimize your tax liability while allowing you to enjoy the benefits of your foreign investments.